start. Okay.
All right, everybody. So let's go to page 4 in your handout, is where we left off. And before we get to the players in the financing, if you look there on page 4 where it says, currently all the innovative finance techniques have helped to get us to around 69% homeownership. Everybody sees that? Okay. And then you'll notice it says plus, plus, plus. What would you say are 3 of the main benefits of homeownership? Homeownership. Why do people like to own a home? Build equity, decorate the way they like. Great, Shauna, yes.
Tax advantages.
Tax advantages, that's a good one. What about the tax advantages? What can they deduct?
Interest.
Interest, great. So plus interest deduction, that would be one. And we talked about how that's a little under fire, so we'll see what happens with that. What else can they deduct?
Property tax.
Property taxes, great. So plus deduct property taxes. And what was the other big benefit we talked about? It changed in May of 1997. Capital gains, excellent. Capital gains on your personal residence. So remember, that was the section 121. So that's that 250, 500. A lot of people, like to write 250, 500. That reminds you what that is. Remember, you use and own the home as your personal residence for two out of the last 5 years, right? Then you qualify for that section 121. That allows you to be exempt from capital gains. One of the other things that I wanted you to think about, we didn't mention this morning, but remember when we looked at the tax brackets and we talked about the fact that the long-term capital gains rate, everybody would love to pay 5%, but the only people who get to pay 5% are who? People in the 10 and 15% of this bracket. Great. When we said 5 and 15%, I asked you to write down the word long. Remember, we said long-term capital gains. And how did the IRS define long? Over a year. What if you were working with a client and they wanted to do a fix and flip? Bought a house, fixed it up, put it on the market to sell it. And they say to you, this will be great, I'll sell it, and then I'll just have to pay 15% on the gain. What would you say? It depends, right? That's right, that's the best answer. Now, here's what I want you to think about. IRS says over 1 year. If they do that, buy, repair, sell it within less than 1 year, they are subject to short-term gain. Short-term gain is at ordinary income rates. So remember the 10, 15, 25, 20, all those numbers? That's where they would pay. Now, if you're in the 28% tax bracket, everyone, I'm sure you all agree that's a far cry from 15%. So that makes a really big difference. Remember we said, a lot of people, you can make an assumption that they know what they're doing if they're investing in real estate, and that's just not always the case. We need to remind people of what it is that they need to do, which is talk to their CPA, right? Come up with a strategy, understand what they're up against before they make some decisions. Okay, good. All right, so let's talk about the players in the loan process. It's down at the bottom of page 4. Loan originators, what's their job? Qualify, great, that's a great start, Kim. Yeah, qualify the people. What else?
Take the application.
Take the application. Great, Carol. Yeah, take the application. That's a big part of it. And if you had to be a little stereotypical for a moment, how would you describe their personality? What do they have to like, and what do they have to do? They have to network and be personable, Shauna says. Very good. Yeah, because it's kind of like a sales job, isn't it? I mean, it truly is. They're out there developing their relationships, getting the people to start the loan process with that particular company, whatever that may be. Okay, good. What about the loan processor? What do they do?
Put all the paperwork together.
Put all the paperwork together. You got it, Clarissa. And they better like sitting behind a desk. Would you agree? Mm-hmm. Definitely got to be detail-oriented, deal with all the paperwork, like just more of a desk job, not a ton of interaction, with clients and so forth. And finally, the loan underwriter. What's their job?
Just review the spreadsheet.
To double check everything, what'd you say?
To hold things up.
To hold things up, she said. You guys are so nice in Missouri. You know what most people say when that goes up? I say, the underwriter's job, what's their take? And people will yell out, kill the deal. Right? They say, kill the deal. Now, I gotta tell you, underwriter, undertaker, I don't know. Okay, quiet conspiracy theories. But anyway, if you were to look up at the screen here, and if I were to ask you, is the underwriter responsible for reviewing loan documentation? What do you think? Yes. Are they responsible for evaluating the borrower's ability to pay the money back?
Yes.
Yes. How about confirming the collateral? Yes. So they are responsible for all of those things. Now, that would be some great information for you to know for your future. Right? We talked about like your 4:30 this afternoon future. But very straightforward. We know that the underwriter is responsible for all of those things. That is why, remember when we talked about the secondary mortgage market, and we said kind of think of it like Fannie and Freddie have this box that people have to fit in. And if anything is sticking out of the box or it doesn't fit in the box, that's a problem because that doesn't meet the secondary market guidelines. Now, one of the terms that I would like you to write down, because this is very important to understand from a lender's perspective, and it's a term that is investor overlays. Has anyone ever heard that term before, investor overlays? Not so much? Well, investor overlays are something that you want to be aware of, and you talk to the lender about this, because while Fannie and Freddie say, here's our box and here's what people have to fit into, the investor, meaning the person providing the money for that loan, they may have even more rules and restrictions above that. So while Fannie and Freddie guidelines could be here, and the buyer and borrower might meet those just fine, the next question becomes, are there any investor overlays that we need to be aware of? That is why sometimes a no to a particular client for a loan may not necessarily mean a no. It may be that there was a particular investor overlay that was in that situation for that lender that maybe a different lender doesn't have. All right, so that's always a good question to ask about the investor overlays. All right, the main document is the loan application. So somebody brought up that the loan originator does that. There's our two most misused terms, right? Pre-qualified, pre-approved. You guys got those. Now, this next section, this is not all written out in your handout because it's mostly review for you. And I would suggest to you, you don't feel like you need to capture everything and write it all down. It's just follow along with me. If there is something that you feel like you've missed or you'd like it, you're just going to email me and say, Chandra, I'd like you to send me this and I'll do it. Is fair enough? Okay. So when it comes to employment, we know that the lender's looking for the last 2 years at least, right? So they want their history. They're going to ask for the W-2s, certainly. They want proof of any other income, maybe that's pension, retirement, disability, etc. Child support, alimony. They're going to require pay stubs, all this documentation. One of the best things that I did was I got with the lenders that I have on my preferred lender list, and I asked them to share with me a list of what the borrower would need to bring them. And I got the list from them. And then on the list that I have, here's the lenders that other clients have used and been satisfied with. And you list, like 3 lenders on there and they choose. On that sheet of paper, along with my logo and letterhead and so on, I have the list of what they'll need to take to the lender. Now, that has been really helpful for a couple of reasons. One, people get overwhelmed. I think everybody's a little bit nervous to go to the lender. They don't know what's involved. The numbers are a little bit scary to them. And if I can help by saying, here's what you will need to start gathering, and they can at least be starting to put that together, when they go to the lender, they're not just hit with that all at once, from the lender. And that's been great. It was very easy to put together. Just call your lender and ask them, for that information. And then you'll have it. You can put it on your preferred lender list. All right, anybody who's self-employed? Yeah, everybody in the room, right? We can relate to that. What's interesting is being self-employed is probably one of the toughest positions to be in when it comes to a loan. Do you remember the loan product that they had called NINA? No income, no assets? Right, like a stated income loan, no doc loan, so some of those terms may sound familiar to you, but those are in the past because we don't have a lot of stated income products or no doc loans today, right? That's a little bit different today. So we're looking for 2 years tax returns and a current profit and loss statement. Now, a lot of times the lender may require an average of the last 2 years. Now, if you're self-employed and you know a little bit about the tax code, what does your income tend to look like? Negative or as little as possible, right? Absolutely. So again, everybody, this is where the strategy comes in. And sometimes people get to make a business decision. I'm going to, show the appropriate income so that I can, get the loan that I need and so on. Because it's just a challenge on the self-employed side. Then they want to know, who do you owe and how much? Right? Tell us your creditor's name, how much you owe, what's the address, the amount that's owed, etc. Then we got to do the same for the banks, right? Where do you have your bank accounts, account numbers, bank statements, and so on. Okay, so just the banking part. And they want to have any other assets listed, right? So any other assets, could be a note you could jot down, any other assets. If you're looking for VA eligibility, there's a form, the DD-214 form. The lender, helps the eligible veteran to obtain that. And if we have student loans involved or a gift letter, maybe there's a divorce. When you have a divorce situation, people could have on their credit report some financial obligations that the divorce decree says is the responsibility of the other party, correct? So that's where we might need, divorce papers and so on to show how that liability is laid out. Us as realtors, maybe we need to get the sales agreement, certainly, copy the earnest money check. Maybe they're contingent upon the sale of their property that's currently listed. The lender wants to, see that type of information. And then come all the verifications, right? The verification of their employment, of the bank's deposits, of the outstanding loans, of the earnest money deposit, and so on. So all of the verifications. Okay, we're going to do a quick little exercise before we move into credit scores. Now, there's nothing to write down. I just want you to follow along. And in fact, I'm going to ask you a question, but you don't even have to shout out the answer until you confer with your neighbor, right? Because you want to be sure before you shout it out. All right, so we've got a ball and a bat here. Together, they cost $1.10. Now, the bat is $1 more than the ball. Everybody got it? So here's the $1 million question. How much is the ball? Okay, go talk to your neighbor, come up with the answer. All right, what'd you get? I hear it depends. Great, somebody else have an answer? Give me a number. 10 cents. Oh, most people shout out 10 cents, okay. Here's the bad news, everybody, that's wrong. Here's the good news. 50% of Princeton students also got this wrong. So if you're gonna be wrong, be in good company, I suppose, right? Here's what I want you to think about. What's the only thing that I told you? A couple things. Together they cost how much? $1.10. Okay, great. So they cost $1.10 together, and the only other piece of information I gave you is the bat is $1 more than the ball. Okay. So if you were to tell me, okay, well, Shannon, the ball's 10 cents. In order for the bat to be $1 more than the ball, how much would the bat have to be? $1.10. Does everybody see that?
Yeah.
So if the bat's $1.10 and the ball is 10 cents, how much is that? $1.20. That doesn't work, does it? It's not the way it works. Now, we could figure this out with some algebra, and we're not going to do that. Remember, I promised you, no major calculations today. So here's what it is. The ball's 5 cents. And the reason is if together they have to be $1.10, as you can see here, but the bat has to be $1 more than the ball has to be 5 cents. Everybody see it now? Yeah, because it makes sense once we walk it through and explain it. Here's the reason that I share this with you. You're all intelligent people. We have people with a lot of experience in this room and a lot of experience in the real estate business. Done a lot of deals, seen a lot of loans, all of that. I asked a question. Most people were, yeah, it's 10 cents. And I just want you to think about the ball may not always be 10 cents, as it may seem. And it's really important, especially in our business. Sometimes our ego could get in the way. Sometimes our years of experience could get in the way. And we might think, of course I know how that works, or of course I know the answer to that. But you may want to just take a step back, think about this silly exercise, and think, you know what? Maybe it's not 10 cents like it may. Alright, so just keep that in mind as we move forward, especially on our next topic, which is credit scores. Now, how many people in the room have ever lost a deal due to someone's credit score? Yeah, look at that. Almost all the hands are up. The better question, I guess, is how many people haven't? Right? I mean, that would be the probably lesser number. All right, well, look in your handout, if you would, on page 5. And I'd like you to just follow along here. It's all written out in your handout. And just follow along with me as I read aloud. It says an individual's credit score can affect where they work, what car they drive, what they pay for insurance, and where they live. By the way, do you agree with that statement?
Yeah.
Absolutely. Right? Credit score is king, as we would say. It is imperative to know how credit scoring works and how to achieve the highest score possible. What is a credit score? Well, credit score is derived from information provided by the credit grantor. So this would be credit card companies, home loans, auto loans, department or retail stores, etc. Information also comes from court records. This would be bankruptcy filings, tax liens, and judgments. A credit score is a numerical representation of your statistical likelihood to repay credit that has been extended to you. Now, let's talk about the term credit grantor for a moment, just to review. Do you remember sitting in real estate school thinking to yourself, you know what? If I hear one more word that ends in OR or EE, I'm going to be physically ill. You remember thinking that? I mean, it was insane, right? Lessor, lessee, grantor, grantee, mortgagor, mortgagee, it just went on and on. So I'm curious if you learned this trick. There was a little tip or trick, and maybe they taught it to you. And it goes like this. They said, look, if a word ends in OR, okay, if a word ends in OR, think of that as the givor of something. Now, you had to go with it phonetically, of course, right? So you think, okay, that's the givor of something. If a word ends in EE, think of that as the receiver of something. Again, you had to kind of roll with it phonetically, all right? Does anybody remember that trick? Did you learn that little tip?
Good.
No? Yes? No?
It would have
Okay.
been nice.
It would have been nice, she says. Now you tell us, Chandra, next one. Okay. This still will be useful for you because think of all the words that we run into seemingly on a daily basis. Let's take lessor, lessee. So you think, okay, lessor. Who is giving the lease? Who's giving the right to occupy? Well, that's the landlord or the owner or so forth. So great, okay, the landlord or owner is the lessor. Who is receiving the right to occupy? That's the tenant. That's the lessee. Oh, great, that makes sense. Okay. Now, let's then look at mortgagor and mortgagee. All right, we got our OREE rules down. Now, who is the mortgagor? I hear the lender, I heard the bank, I heard someone say the buyer.
No, it is the borrower.
It's the borrower. Very good, it's the borrower. Now, I'm going to write this up here, borrower. Let's talk about how the rule works. Where people get confused is the true definition of a mortgage. The definition of a mortgage is pledging real property as security for the debt. Now, we use the term incorrectly, technically, all the time, don't we? You know, people will say, oh, I'm going to buy a house, I need to go get a mortgage. So it makes you think they are receiving a mortgage. But the truth is, they're giving a mortgage and receiving money to buy the real estate. Right, so our little trick works. Okay, so by default then, the mortgagee is the